Friends, do you know what's unfolding at the heart of global finance? Beneath the seemingly calm credit market, a hidden banking crisis is silently spreading. The epicenter of this crisis is private credit. Private credit, this shadow financial system, is once again threatening global financial stability, but in a way distinct from the 2008 Lehman shock. It primarily refers to the non-public direct lending market. Over the past few years, as traditional bank lending tightened, the private credit market expanded rapidly. It offered flexible financing to businesses, attracting many investors seeking high returns. Especially during periods of rising interest rates, private credit, with its floating rate nature, delivered surprisingly high returns. This made it a darling of the capital markets. However, behind this apparent prosperity, increasing signs of unease are hidden. For instance, Deutsche Bank's stock price recently plummeted, dropping nearly 0.30% since the beginning of this year. It's not just Deutsche Bank. Other major banks like Wells Fargo in the US are also experiencing similar downward stock price pressure. This is by no means accidental market volatility. The stock price decline patterns of these banks are almost identical to those of asset management giants like BlackRock and Blackstone. This suggests a deeper underlying connection. The market is now filled with doubt. Everyone is watching to see who will be next to be caught in the private credit collapse storm. Panic is quietly spreading. The biggest weakness of private credit is its inherent lack of transparency. It operates in non-public markets, leading to information asymmetry. Unlike public markets, private credit assets have no public market price. This means their true value is difficult to objectively measure and assess. Investors pour money into it, yet cannot accurately grasp the true state of the assets. They must rely on management reports, which introduces significant risk. This lack of market pricing can lead to inflated asset valuations. Once market sentiment shifts, the true value could be rapidly exposed. Even more concerning is that institutions like insurance companies and pension funds have heavily invested in private credit. These are funds crucial for public welfare. If the private credit market collapses, it will not only impact financial institutions, but also directly threaten countless families' pensions. This would have immense social consequences. This hidden banking crisis demands our utmost vigilance and attention. Understanding its potential risks is the first step to protecting our wealth. Financial and government funds, chasing higher yields, are aggressively pouring massive capital into global financial markets, creating significant market liquidity. The prevailing everyone else is doing it herd mentality has completely obscured genuine risk assessments. What appears to be irrational market exuberance is actually concealing unforeseen major crises, demanding our vigilant attention. However, the myth of a strong economy is steadily crumbling before reality. Now we must debunk this illusion. What exactly is transpiring deep within the market? Next, we will reveal 3 undeniable and clear warning signs. The first warning sign is the sharp surge in the dollar index, DXY. A strengthening dollar signifies a massive withdrawal of global capital. This is not merely a single currency's change, but reflects widespread capital outflows. Global liquidity is consequently facing severe challenges. As the dollar continues to strengthen, global market liquidity will be drastically tightened. This makes it increasingly difficult for businesses and individuals to secure necessary funding. Borrowing costs are consequently rising steadily, exacerbating financing challenges. The second warning sign is the sharp decline in bank stocks. Between 2022 and 2023, bank stocks which had performed strongly are now once again facing a downturn. This indicates that within the financial system, there might be deep-seated structural issues. The private credit sector, which previously drove bank profit growth, has now become a heavy liability for banks. These assets, once considered high-yield investments, are now transforming due to default risks into potentially massive debts. The third warning sign is the withdrawal restrictions on investment funds, also known as gating. Many funds have begun to limit investors' access to their capital. This measure directly cuts off financial liquidity. For the market, this is an extremely dangerous signal. When capital flow is forcibly halted, credit distrust will rapidly spread. This is akin to a shadow banking version of a bank run. Market panic will be triggered instantly, potentially causing a chain reaction. Beyond these specific warnings, the macroeconomic landscape is also revealing significant changes. Economic data no longer supports the narrative of a strong economy. Now, we need to examine more deeply these broad and profound macroeconomic shifts. In the United States, over the past 9 months, 5 months of non-farm payrolls showed negative or extremely weak growth. This data clearly indicates that the labor market is losing its previous momentum. The pace of economic recovery is far less robust than anticipated. Similarly, Canada is also facing severe employment challenges. Its employment statistics show the worst performance since 2022. This is not merely a problem for one nation, but a global sign of economic slowdown. Therefore, the narrative that the economy is still strong can no longer align with the cold, hard data of reality. This is an undeniable truth, forcing us to reevaluate the current economic situation. We must confront reality. All these warning signs collectively point to one truth. The claim of a strong economy is merely a carefully crafted illusion. We must courageously expose it to truly comprehend the current crisis. Looking back at history, these signs inevitably bring to mind the 2008 financial crisis. The market back then was also blinded by similar illusions. We must learn from it to avoid repeating past mistakes, which is crucial. Only by confronting reality can we find genuine solutions. We need deeper analysis and clearer judgment to address these challenges. Staying vigilant is our only way to protect our wealth. Many experts say this won't be as bad as Lehman Brothers, but asset mispricing and liquidity drains are strikingly similar. Investors must now immediately focus their attention on two critical financial indicators. In the coming months, we must learn to meticulously read the underlying financial structure, not just cold, surface-level numbers.